Welcome, everyone. We are pleased that you have joined us for today's webinar titled Split Dollar in the Real World, Coach Harbaugh Case Study. The webinar will last approximately 15 minutes, and at the end you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus now writes extensively for life insurance industry publications, and he speaks regularly at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, life insurance, and practical experience for today's webinar, and here he is.
Thanks so much, Lisa, and good morning, everyone, or afternoon, depending on where you are. I'm going to spend the next 15 minutes on this split dollar update, including a focus on the Coach Jim Harbaugh situation with the University of Michigan. And I recognize in 15 minutes it's impossible to do any kind of talk on split dollar justice, but if you're interested in learning more, particularly about the Harbaugh split dollar plan, and if you're interested in seeing the whole split dollar agreement in particular, I'd suggest that you contact Lisa after the call and ask her for a copy of the newsletter, because it really is quite interesting what they did there. So again, thank you for joining us here this morning. The news from today's webinar, the takeaway from today's webinar, from my perspective, is that split dollar plans are back in fashion. Between 2001 and 2003, the IRS came up with a series of notices and regulations with regard to split dollar, which took away a lot of the strategies that life insurance professionals used back then, particularly with their business owner clients, and made those strategies harder to implement and less attractive. I think our industry has been struggling since then to figure out exactly where split dollar plans might fit going forward. And we've gotten two examples in the past year of situations where split dollar has been implemented successfully, and has been implemented in a way that addresses problems or meets family or business objectives. And I want to talk about those situations here today. Talk about a family situation, talk about also a business situation, the Harbaugh case. And I want to talk about loan regime split dollar, at least to a certain extent, and economic benefit regime split dollar. And before I get to the Harbaugh case, let me at least spend a minute or two on the Morissette case. The Morissette case, decided by the tax court earlier this year, has to do with family split dollar, unlike the Harbaugh case, which is business split dollar. And the Morissette case also has to do with economic benefit split dollar rather than loan regime split dollar, which the Harbaugh case deals with. So let's talk a little bit about the Morissette case. The Morissette case is really an intergenerational split dollar implementation. It's a family situation where mom was intending to help her kids finance needed buy-sell coverage. The kids were active in the business. They needed buy-sell coverage for covering their buyout obligations in the event of the death of one of the siblings, and mom was helping to finance that situation. The parties implemented an economic benefit split dollar plan where the kids, through their trusts, owed mom, through her revocable trust, the greater of the cash value in the life insurance policies or the premiums that were advanced. And they owed that money in the event of the termination of the plan, the surrender of the policies, for the death of the insureds. And this was administered under the economic benefit split dollar regime. That meant that each of the kids recognized a gift tax result, or mom was making a gift to the kids equal to the table 2001 economic benefit rate for the life insurance on each one of the kids' lives. And that's how the economic benefit regime works. You use the table to figure out the value of the income taxable result in a business situation, the gift tax result in a personal situation like this one. And so that's how they put together the plan. When Mom died in 2009, the IRS audited her estate, and the IRS argued that the premium advances that Mom made to the policies that were subject to the split dollar agreement were actually gifts. And it wanted to impose gift tax rules and potential gift and estate tax penalties on those premium advances. And so the estate for Mom disagreed with that assessment, took the case to the tax court, and the tax court said no to the IRS. The tax court decided that this was a legitimate economic benefit split dollar implementation, that the parties were implementing and administering the split dollar plan properly, and the IRS found on its main decision at this point in the case that split dollar works in a family situation like this one. So that was the first good news from this case. That Mom did not make a gift of the premiums to the kids or the kids' trusts, but in fact was only making a gift of the economic benefit under the split dollar plan to the kids and to the kids' trust, and that was done properly. Now, there was a little bit out of the Morissette case that has not yet been decided. Mom is owed back the greater of premium advances or cash value out of these life insurance policies. And in the aggregate, the premium advances were about $29 million. And so the question was, what should be included in Mom's estate for estate tax purposes based on the split dollar agreements? Should it be the $29 million that would be collected if the insureds died tomorrow? Should it be the cash value of the policies today? Should it be some different number? And that question has not been answered. Mom's got an expectation to collect in the future if the policies are surrendered before the death of the insured. If the cash value growth is not very good, Mom's expectation to collect might be substantially less than the $25 million of premiums that she advanced. And so the IRS and the estate are still working out, and they may ultimately need the tax court's help, are still working out how much that value might be worth in Mom's estate. And so not all the questions have been answered about intergenerational private split dollar plans, but we do know that these plans can be used to help control the gift tax costs of the financing generation along the way. So that's the first piece of good news about split dollar that we have from this year. The second piece of good news, and it's why you're on the call today, is the Jim Harbaugh split dollar plan. If you read the press, you saw that the split dollar plan was being touted as being worth potentially millions of extra dollars to Coach Harbaugh. It was being touted as a really significant part of his compensation package with the University of Michigan. And while the implications of the plan are significant, I'm not sure that all of the hype that we heard from the press was fair. However, it is unusual for a life insurance related compensation idea to get such a high profile coverage in the mainstream press. So that's probably good for us that it did hit the press. So what did Harbaugh and the university agree to? So the university agreed to pay 6 annual premiums into this life insurance policy of $2 million each. In the event of the death of Harbaugh or the termination of the plan, Harbaugh would agree to repay the university its premium advances without interest. And explicitly in the agreement, the parties agreed this was going to be treated as a loan-based split dollar arrangement. Harbaugh's liability to the university would be non-recourse. That is, it would be limited to whatever was in the parties. And both parties agreed to assure the IRS that the premium advances would be likely to be repaid in full, which is a little bit of a trick under the split dollar regulations to make sure that relatively favorable loan regime rules can be applied to this circumstances. So what are the tax implications of a loan-based split dollar plan? The loan regime requires the employee to either pay the interest on the loan or recognize the unpaid interest each year at federally acceptable rates. The rates that the parties can use for this particular split dollar implementation, if they use the June rate, which is when the split dollar agreement was kind of announced in the press, and which is the date that this agreement apparently went into effect, they could use a 2.24% rate for the first premium. And what that means is that Harbaugh will recognize imputed income of just under $45,000, and you can see the math there. The $2 million premium advance times the rate equals $44,800. So $2 million goes to work for Harbaugh right away. He pays income tax on $45,000 of income. Each successive loan under this particular split dollar implementation will have its own interest rate. We've had relatively low interest rates for a significant period of time, and so it feels like that all of the split dollar loans for the Harbaugh case are likely to have relatively low imputed income tax rates that may be near the level for the 2016 rate. So what are the things that we can take away from this? First of all, this was attractive enough to Harbaugh and his agent for them to say yes to the plan, and so there's still a place for split dollar planning for highly compensated employees. Clearly, Harbaugh is highly compensated, and it makes some sense for him to think about accepting this kind of a plan. What does Harbaugh get? He gets relatively cheap life insurance coverage and the potential to access policy's cash value tax-free if the policy performs well. So if the policy performs better than the loan interest rate for the first loan, remember, is 2.24%. If the policy generates a return in the 4 or 5% range, he's going to have equity growth on his side of the ledger that's going to be bigger than his tax liability along the way, and so that's the upside for him. From the school's perspective, the good news is that the agreement has the potential to tie Harbaugh to the University of Michigan for the next several years. If Harbaugh wants to get continued premium advances, he has to stay employed by the university. And so, although there are constantly rumors about Coach Harbaugh perhaps going back to the NFL, the fact that he'd be giving up his right to substantial life insurance policy and potential upside on the cash value growth really might make him think twice. And the other upside from the school's perspective is that the school is likely to be able to recover its premium advances in the future, and that lowers its risk under the split dollar agreement. Now, what are the downsides? The downsides for Harbaugh are that if cost of insurance rates or credited interest rates or both underperform the loan interest rates associated with the premium advances, he could end up with nothing. He could end up, paying an income tax result along the way here, and if he doesn't die along the way, which of course he hopes not to do, then if eventually when he leaves Michigan, Michigan could claim all of the policy's cash value and Coach Harbaugh walks away with nothing. In the short term, there are minimal cash value benefits for Harbaugh. Long term, he may participate in cash value equity as and if it grows bigger than the loan interest rate. In the short term, he does get access to the death benefit, but that's it. And of course, there's interest rate risk, which we've kind of talked about this. For the university, the risk for them is they may take a loss or get no return on their capital investment. If Harbaugh leaves early and the university decides not to keep the life insurance in force, they take the life insurance in settlement of what Harbaugh owes them. If its cash value is less than what they put in, or if there's no positive investment return on the cash value, it doesn't get much extra. So that's the risk from the university's perspective. Now, having said that, for all the downsides that we pointed out here, it probably is a plan that makes sense. As I said earlier, obviously Coach Harbaugh and Coach Harbaugh's agent decided that this was worth pursuing. And if he needed the life insurance coverage, why not? This makes perfect sense for him to leverage his contract with the University of Michigan to provide what it is that he's looking for with regard to his personal financial goals. The downsides are, I mentioned those kind of to temper the headlines, the hype that we saw in the press. There are downsides. This isn't a panacea, but it still was a good plan. I want to thank you for joining us today. If you would like to reach us by email, feel welcome to contact us at the email address here or at 615-224-1291. Let us know if you have questions about today's webinar or how else we might be able to help you. And at this point, I'll turn the program back over to Lisa.
Thank you, Linus, and thank you everybody for joining us today. And like Linus said, if you'd like to receive any supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. And again, you may also email questions related to today's webinar. And for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Thanks again, and best wishes for continued success.